Okay, look into it. Very excited for this video. This is a very important video, and in my opinion, I think this is probably one of the most important educational videos that I will post. And it's how to pick the right contracts for options. You know, a lot of people do not realize that picking the right contracts is more than half the trade itself. So I figured I'd make this video to educate you folks. You apply it to your own trading, and I promise you, if you use options the right way, trading becomes very easy. It becomes very simple. So please don't forget to like, subscribe, and let's get into it. So you always hear me say, right, we got to know what we're looking at. We got to know what we're doing. If you want to trade and you want to be a consistently profitable trader, you got to know what exactly it is that you are trading. If I say, hey, you trade for a living, oh, what do you trade? And you say options, you got to be able to tell me what options is, right? I think we can agree on that. So, what are options? An option is a contract that gives the buyer the right, but not the obligation to buy or sell an asset at a certain price on or before a certain date. This is why contracts have expiration dates. So I'll give you a simplified example. Really hope this makes sense. So in simple terms, when I personally like to explain what an option is to someone, I use this example. Now, for an example, let's say NVIDIA is at $100 and you buy a $105 call option for NVIDIA that expires on Friday. For the sake of argument, let's just say that it's Monday, it's the start of the week. So in simple terms, I am saying I think that NVIDIA will go above $105 by Friday. And if my analysis is correct, my call becomes valuable. And if it doesn't, the option becomes worthless. So what does that mean? That means as the price moves in my favor from $101, 103, and we're climbing towards 105, I am making money because my thesis is becoming correct. I am moving closer towards 105 and so on. So I will make money as that call goes up. Now, if that call goes against me and now the stock goes or the price goes from 100 to 99, 98, 97, I am going to lose money. I'm going to lose money because now those contracts are going against me. They are no longer climbing up towards my target, which is being 105. Hope that makes sense. Now, why options? Everyone trades options for different reasons. These are my personal reasons, but these are also factual reasons as well. So, why options? Why do people trade options? You make more with less money. We always hear that. You've heard me say that. The beautiful thing about options is you don't need a lot of money to make a lot of money. Risk is limited to what you paid for the cons. So in simple terms, you can't lose more than what you put into a stock or into that trade. So for an example, let's say I have a position on NVIDIA and total it all comes up to $1,000. If that thing goes to zero, right? If I let that go all the way to zero, I can only lose $1,000. I can't lose 1,005, 1,010. I can only lose 1,000. You can profit faster from smaller moves, which is very true. This is why they say, hey, scale into those momentum pushes, those pops. You make a lot of money and you make more money on those smaller moves, but the momentum is your best friend. Why? Because now those contracts are starting to move into the money and those premiums increase as well, paying you more. And you never actually have to buy the real stock itself, just the contracts. So as we know, if you're trying to trade individual stocks itself, for something like that, you do need a lot of capital. If I'm trading, Tesla, and let's just say the price is sitting at $300 a share, I'm going to need a lot of shares in order to actually get a decent return on trading those individual stocks. So hope that makes sense. Now, basic terminology. As we know, in options, there's a lot of Greeks, this and that. I'm only going to give you the terminology and the definitions and the words and so on that you need. I'm not going to confuse you with everything else. These are the main things that you need to know. I don't think, me personally, I don't think that you need to know all the Greeks and all that stuff. These are the main things that you should know, though. The basics. So, premiums. What are premiums? This is the cost of the option contract. This is the price being paid by a buyer or sellers, remember, for the rights to a contract. So, for an example, that's just going to vary on at the money cons, in the money cons, or out the money cons. Theta. This is very important. This measures an option's time decay. Early in the week equals less risk. End of the week, very risky. I'm going to give you visuals on how we utilize these things and how we utilize this to our advantage. So for an example, with the theta, you hear me say, all right, it's Monday, it's Tuesday. I'm playing two strike prices out of the money on Tesla. The reason for that being is because I'm not worried about theta. These contracts aren't as volatile. They're not as risky. But as we get closer to expiration date, the theta, right, that's going to work against us. That becomes very risky. Why? Because those contracts are expiring. So something that I typically do and that I was taught is at the start of the week, I'm aggressive. I'm using the start of the week to build cushion. As the week goes on, we get a little bit more defensive. And Thursdays and Fridays, we are 100% on defense. I'll explain that as we go on. Strike prices, very important. You should know strike prices. This is the agreed upon price to buy or sell an asset. So, in simple terms, how much our contracts will cost us at the money or in the money contracts is going to cost us a little bit more than out the money contracts. Why is that? Because out the money contracts, they're a bit lower probability, right? They're further away from your profit target. I hope that makes sense. They're further away from your profit target. And they have a higher chance of expiring, I'm sorry, a lower probability of expiring in the money. They are also higher risk because they're further away, like I said, from our strike price and theta decay. So for an example, let's say I play two strike prices out of the money on Apple, and Apple starts to goes against me. my stop loss is going to be very big. Why? Because now those contracts are going further out of the money. You're already starting out of the money contracts. If it goes against you, guess what? They're moving further out of the money. And delta, very, very important here. Sometimes in my trading, in my live trading sessions, you hear me say, hey, the delta right now is sitting at 30. I'm going to pass on that. I'm going to get into that. But delta measures an option sensitivity to every dollar change in the underlying asset. So in simple terms, you're going to make X amount, depending on the delta, for every $1 move on that stock. So however much a stock moves on the dollar amount, the delta equals how much you will get paid for that $1 change being moved. So for me, a general rule of thumb is if a delta is if it's under the 40s, I'm not touching it. I don't touch delta under 40. To each their own. For me, anything in the 40s is okay, preferably 45 and higher. 45 and 50, that's the sweet spot. That is perfect for me. So sometimes you hear me say, yeah, I don't really, Apple looks good right now, but the delta is sitting at 30. I don't like that. I'm already starting this trade at a disadvantage. Why? Because if I get a big move in my favor, I'm not getting paid that much for every dollar move. Hope that makes sense. So why contract selections matter? Four main reasons here. Four main reasons. Your entry plus direction is only half the battle. I can't emphasize that enough. I've already said this. Picking the right contracts is more than half the trade. It's more than half the trade. You can ruin a perfect A plus setup by picking bad contracts. So that's number one. Number two, the wrong contract can ruin the perfect setup. We know that. So what are good contracts? You may ask me, all right, Kel, well, I know that, but all right, what's a good contract look like? Tight spreads, faster fills, better risk to reward, cleaner price action. So high volume, high liquidity. What are bad contracts? And I'm gonna give you a definition and we're gonna get into this. Slow fills, less volume, less liquidity, and they're more volatile. Anything with a wide spread, I stay away from. So for an example, for me personally, how I trade, if a spread is bigger than 15 cents, I'm gonna stay away from that. Don't worry. We're gonna go into the charts. I'm gonna give you a visual of spreads. But the tighter the spread, the better. Now, what is our overall goal? To stay liquid, to stay efficient, to stay selective. And this is why you always hear me say less is more. Less is more is part of your edge. It's your advantage, right? That's your edge in the market by having less is more. Now, what are we looking for in a liquid contract? We got to know exactly what we're looking for. High open volume, high open interest, tight tight spreads, which the bid and the ask. So for an example here, let's say the bid is 100 and the ask is 115. For me, that's perfect. That's a tight spread. If I'm looking at that, okay, cool. I'm gonna take my shot here. I'm gonna trade these option contracts. Well, let's say the bid is 100 and the ask is 130, 140. That's a 40-cent difference. I'm not touching that because now I'm already starting at a disadvantage. Now, why does that matter? Better fills, lower slippage, easier to scale in and out. We're gonna get into this a little bit more. But remember, when you are trading and you're buying and you're selling, that is a transaction. You're not selling to a fairy tale on the other end. There's someone else that is buying and selling to you. So this is the stock market. Keyword market. This is a transaction. You go to the grocery store, you buy groceries, your transaction, right? They give you groceries, you give them money. So even when you were trading, this is a transaction that is going on. So this is very important to have tight spreads. Liquidity is king. For these reasons, this is all part of risk management. This is why you always hear me say, I am a risk manager before I am a trader. Now, why we stay away from wide spreads? It's very important. I really want to hit on wide spreads because when I first started my trading journey, I had no idea, what spreads were and the bid and the ask, and I want the bid to do this and do that. I had no idea. Started to learn, right? You become a great trader from being a loser. You got to lose in order to learn. I hate to say it, but it's true. Everything that I know now is not from a textbook. It's trial and error. You know what I mean? So as soon as you enter a trade, you're at a disadvantage with a wide spread. How? This often means that the contract is illiquid, meaning less volume. We don't want that. The higher the volume, the more liquidity, the better. We get in and out of our trades. So this makes it very hard to scale out or exit a trade, even if you get the move in your favor. Remember, it's a transaction. So if you're trading a name that has low volume and low liquidity and you're selling, remember, you're selling to someone, even if you do a market order sometimes, for me, in the past, it's been hard to get filled. It's going to be very hard for you to get out of that trade. That's why liquidity is king. So if you're ever down and your stop loss is bigger due to wide spreads, and the worst part is you probably can't even get filled for a loss when you try and exit, which also means your loss on that trade is going to be bigger. Why? Because you're stuck in the trade. You've taken a trade on a name with a very wide spread, low volume, low liquidity, and now it's hard to get out of that trade. I've been there before, and my anxiety was through the roof, and I took a very big loss. This was many years ago. I can't remember the name. I wish I could, and I was so confused on that. I was like, why is that? And then I learned, oh, this thing has wide spreads, so it's not going to be as easy to get in and out of a trade like you can on SPY or QQQ, which is SPY is the most liquidated stock in the stock market compared to a name with a very wide spread. I hope that makes sense. So this is why we stay away from wide spreads, primarily because they indicate low liquidity and high transaction costs. Wide spreads are the results of high volatility or low volume. Say that one more time. A wide spread are the results of high volatility or low volume, meaning the difference between the bid and the ask is large. That's a simplified version. That just means the difference between the bid and the ask is large. That's a wide spread. Hope that makes sense. So making it more expensive to enter or exit the trade. We don't want to do that. We don't want to enter a trade and we're automatically starting off with a disadvantage. You always hear me say that when it's a high IV, when the spreads are tight or when the delta's low, or you always hear me say on the 0 DTE, as soon as you enter that trade, you're entering at a disadvantage. Why do we want to do that? Self-inflicted wounds, right? Control what we can control. This is why I always say we are risk managers before we are traders. Now, IB, this is very important. I've been getting asked this question a lot because in my live trading session, you hear me say, oh man, for the past 3 weeks, great example, AMD, the IB has been through the roof. So you hear me say, oh man, on a technical analysis standpoint, this is a great setup, but the IB is very high, so I'm not going to take this trade. I've been trying to teach you the difference between missing a trade and skipping a trade. So what does high IB do? This affects the price dramatically. And this is typically when, there's a high expected move or FOMC or earnings. So high IB occurs during earnings or FOMC. These are just some examples of when you can see them occur. Now, what falls under that? Expensive contracts, increased IB crush risk. What does that mean? That means if I enter a trade and the IB is higher than usual, I'm already starting at a disadvantage. So that means if that trade goes against me, I'm going to have a bigger loss than I anticipated. And if that trade goes in my favor, I'm going to make little to nothing. Why do I want to enter that trade? Right? We're risk managers before we are traders. So it's harder to profit even if your thesis is correct and bigger theta burn intraday. So what does normal IB look like? What does low IB look like? Cheaper contracts, more stable price movement, easier to scalp in day trade, and less emotional swings on contract value. See how all these things fall under proper risk management? So I've been trying to teach you to build the habit of as soon as you enter a trade, you need to look at the IB in the top right-hand corner. At least that's what it is on TOS. I'm looking at the IB. Less is more. We'll get into that. So how to pick the right contract is what we're all waiting for, right? How to pick the right contracts. So this varies on the stocks that you are trading, right? So your strike price, you picking the right strike price depends on four main things. Number one, the name of the stock that you are trading. That is number one. Number two, and this is probably this is the most important, how much that stock moves on the dollar amount during the intraday. We're going to get into that. This is why less is more. You learn the personality of the stock. Three, how many days until expiration? So I'm going to trade a little bit differently, and I'm going to pick strike prices differently on a Thursday or a Friday compared to a Monday. Less is more, and this is why this is so important. I can't stress this enough. I know you guys are tired of hearing me say it, and I'm going to continue to say it. Less is more. The reason for that being is because you learn the personality of the stock. By you doing that, that gives you an edge in the market. That is your edge. Knowing the personality of that stock, the daily dollar range that it moves on average, right? The average IV on that stock, how well it moves on the underlying. So knowing how much a stock moves on average in a day is crucial on picking the right contracts. So there's been plenty of times you hear me say, I'm looking at Tesla, but on average, Tesla moves $15 to $20 in a day. We're already overextended. We've already moved $20, $23 in a day. I don't like this technical analysis setup. Even though I'm getting the break and retest, I know that we're very extended. So either we can start to chop or consolidate. Yeah, I might skip this trade because if I'm playing a name, let's say Tesla, I'm looking to play calls. I'm playing maybe one strike price, two strike price out of the money. We're already extended more than $20. What is the probabilities of this name continuing another $5, $10, $20? The probabilities are low. So that's when I say, yeah, I don't think this trade is worth the risk because we already got the move. Hope that makes sense, right? Understanding the average IB on that stock. You should know the average IB on Apple, on AMD, on Nvidia, and Tesla. So this is why less is more. Have your handful of names that you trade, and if I'm talking to you, I should be able to ask you any question and you should know off the top of your head. If I say, oh, okay, well, you trade Apple on a daily basis. All right, what's the average IV on Apple? You should know that. What's the average dollar amount that Apple moves in a day? You should know that, right? Less is more. That's part of your edge. This is how I skip trades versus missing trades. Very big difference here. I really want to teach you that. So the main names that I trade is SPY, QQQ, Tesla, Apple, Nvidia, and AMD. This is what you see pretty much 9 times out of 10 on my chart. Now, my side watches, this is typically what I look at when some of these names are in a consolidation period. They have earnings coming out, right? I'm putting names in rotation. So Amazon, Palantir, Google, and IWM. Why these names? Because they have tight spreads, high liquidity, high volume, right? I know I can get in and out of these trades very fast. And these are also tech names. So I really hope that makes sense. Now, a little bit of a little cheat sheet and something that I do, right? And I'm gonna give you what I look at throughout the week, how I'm picking my contracts is very important. This is the cheat sheet, right? And I'm gonna break all this down on the options contract chart, and it will make sense with a visual. Now, Tesla cons on Mondays and Tuesdays, I'm playing 2 to 3 strike prices out of the money. You should know this. Why is that? Because it's Monday, it's Tuesday. I'm not worried about theta. These contracts are not as volatile. On a name like Tesla, and I'll break this down, you can only play that far out of the money because it's a name like Tesla. On average, Tesla moves $15 to $20 in a day, right? So the likelihood of those contracts going from out the money to in the money and hitting our profit target is very high compared to Apple, which I'll show you. You can't play 3, 4 strike prices out of the money on a name like Apple. So Wednesday, right? I'm playing one strike price out of the money. You see how now, as the week goes on, I'm being more conservative. I'm on defense because I don't want to hit Thursday and I'll take a good loss and my loss is bigger than what I anticipated. Why is that? Because it's Thursday, right? Those contracts are around the corner from expiration, so they're going to be more volatile. And we know Tesla on a Thursday, sometimes Tesla moves and looks like a 0 DTE. So on a Thursday and Friday, especially on Friday, I'm playing at the money or even one strike prices or two strike prices in the money. Always see where the price of a stock is sitting before taking a trade. I can't stress that enough, right? This is why you need to know how the daily average of what that stock moves. If that's going to help you say, okay, well, this stock is very overextended right now, and I'm playing out of the money cons, what's the likelihood of this actually continuing another $3 to $4? You see what I mean there? Risk managers before trading. So Nvidia, Apple, and AMD, Monday through Wednesday, I'm always playing one strike price out of the money. Now, this varies. How does this vary? It varies on the ID of that name, and mainly it varies from the delta. So there's sometimes where Apple, one strike price out of the money, the delta's sitting at 30. So I'm automatically not taking that. Why? Because that's how much I'm expected to make on every dollar change. 30 is not that high. So like I said, I want anything in between 45 and higher. Thursdays and Fridays, especially on these three names, I'm always going to play at the money cons or in the money contracts. Remember, it's a Friday. It's a zero DTE. These are very risky. These are very volatile. Control what you can control. So I'm not going to play out the money. And if that goes against me, I'm already instantly down 15 to 20%. I'm going to play at the money or one strike price in the money on a Friday because, all right, cool. If I get a move in my favor, nice. If this goes against me and I get stopped out, it's not going to be as painful. You know what I mean? I really hope that makes sense there. Now, let's get into the chart, what we're all waiting for, right? Now, I'm going to start with Tesla. Very important. I'm going to give you a visual. Now, look at Tesla. So you hear me say in my live trading session, okay, Tesla, I'm looking at this name. The reason for that being, I'm going to play two strike prices out of the money. This is why it's important to know the dollar amount that it moves on average on the intraday. So we know Tesla's moving $15 to $20 in a day. Now, these are 430 calls. Top left, Tesla's sitting at 426. That's barely a $5 move. We know without a doubt Tesla can move $5 within a couple of seconds. We know that very easy. So that being said, I can play two strike prices out of the money here on Tesla, but only in the start of the week. So like I just showed you, Mondays and Tuesdays, I'm playing 2 to 3 strike prices out of the money. Now, look at the delta here, right? You see how it's at 47, 43, 51? This is very high on a name like Tesla. At the money and out the money because, right, this name can move X amount on the dollar amount. Now, look at the IV here on the right-hand side. I'll actually give you a better visual here, right? Make life easier. Okay, look at the IV here, right? See the average? The average here really for Tesla that I know is for sure low to mid 60s. That's typically the average IV for Tesla. Now, why is this important? Because, like I said, I'm a risk manager before I'm a trader. So let's say I come to the day and I'm looking to trade Tesla and the IV sitting at 90, 100. I'm not going to take that trade. Why? Because I just explained to you, I don't want to get crushed on the IV. So as the week goes on, right, let's go here to pretty much a zero DTE because today is Thursday, tomorrow will be Friday, 0 day to expiration. Now, see here, the volume, 153. So we never have to worry about that on names like Tesla, AMD, NVIDIA, because the volume is always going to be there. Now, what is open interest? Open interest, that is the open positions that are not closed yet. These are active positions. So I also use that to my advantage. Look at the spreads. See the 10-cent difference here? Right, the bid is 465 and the ask is 475. That's perfect. That's a tight spread. Down here, 10 cents. See what I mean? I want tight spreads. Now, let's go to a name like Apple. Right? Let's go to a name like Apple. Look at the delta, right? As soon as we go out of the money, it's at 17, it's at 28. Even at the money is barely at 40, but at the money cons are at 54. So what does that tell me? If I'm looking to take a trade on Apple, all right, cool. I'm looking for at the money cons because of the delta. See what I mean? Now, some people can say, oh, well, the volume is higher at, one strike price out of the money. It's Apple. It's very liquid. It's very volatile. I'm not worried about not getting filled on my position here on Apple. Now, look at the spreads here. Look at that. 15 on the dot. I'm taking that. Tighter spread here. Why is the spread tighter? Because the volume is higher. The open interest is higher. Hope this is starting to make sense. But anything under 28.17, I'm not touching that. Now, this is why I say it's very important to know how much your stock moves on a dollar amount on the intraday. And the reason for that being, one sec. Man, this thing does not want to work. One sec. Okay, there we go. So let's look here. Look right. What's the average IV on Apple? About mid 20s to high 30s. That's normal. So if you come into a day and let's say Apple's IV sitting at 60, that may be average for NVIDIA, but that's very high for Apple. So if I'm looking at Apple's IV and I say, man, this thing's sitting at 60, but the average is 20 or 30, what are we going to do? We're not going to touch that name. We're not touching that. Why? Because we don't want to get crushed on the IV. Great example there. Another thing that we already broke down is, right, the delta. This is very important. See the difference between Apple and Tesla? Right? Apple, the delta, as we get further out of the money, look how low it gets. Versus Tesla, 2, 3, 4 strike prices out of the money is still sitting in the high 40s, the low 40s, or even high 50s, right? This is how I'm utilizing these things to pick that. Now, Apple, another thing that I want to hit on here is we know how much Apple moves in a day. It's not moving on average $10, $15 in a day. So on a name like Apple, we can't play 2, 3 strike prices out of the money. We can't do that. Why? Because what is the likelihood of, Apple going from, let's see, the current price right now is 277. What is the likelihood of playing 282? Right? I don't think Apple, the likelihood of that doing so is going to increase and get further into the money and actually hit 282. Now, if you're looking to swing trade, very different. You hold these until the end of the week and hopefully you can get there. But you can see we're already at the end of the week. And is this thing towards 282? Absolutely not. We're sitting at 277.55. Hope that makes sense there. So this is how, you utilize these option contracts to your advantage to make more. Now, Tesla's a great example. I'll go back to Tesla to show you. We know as these contracts move into the money, we make more money. Do we not? Exactly. So this is why a lot of people trade Tesla, because if I'm playing Tesla, two strike prices out of the money, the likelihood and the probabilities, if this name is not extended, getting to 430 and start to move into the money, we're going to make more. Why? Because our delta is going to go up, the premiums are going to go up, and we have a momentum push in our favor. So everything's going to spike, and we're going to start to get paid 2x on our position. Really hope that makes sense. NVIDIA, right? Let's look at NVIDIA. Look at the spreads here. At the money, 5 cents. That's really good. I like that. Look at the spreads here. 5 cents. I like that. See, these are things I'm looking at. Look at on the right-hand side, the average IV here. So now we know the average IV on NVIDIA. So if you come into a day and NVIDIA is sitting at, 80%, 90%, you're like, okay, the IV is pretty high here. I know I'm not going to touch this because why? I don't want to get crushed on the IV. So on a name like NVIDIA, what am I looking at? Right? See, out the money, one strike price out of the money, how the delta sitting at 50. All right, that's solid. I'm okay with playing one strike price out of the money. Now, let's say it's a Friday. I'm okay. Now, these contracts are different because these are next week's expiration, so they're safer. We're not really worried about theta. But let's go here on a Friday. See here, right? This is this week, so the volume has increased significantly. Why? Because it's this week. Contracts expire tomorrow. But see how the price also drops as well? Now, one strike price out of the money is $1. For those who don't know, this isn't $1.73. It's $100, 173 to be exact. So hope that makes sense. But look at two strike prices out of the money. See how the delta is 26? I don't like that. I'm not touching that. Let's look at the fifth. See how two strike prices out of the money is 42? So remember, I'm also using the delta to determine if I want to take a trade or not. So I wouldn't necessarily play two strike prices out of the money on NVIDIA, but that's just me. I'm always going to play one strike price from pretty much Monday through Wednesday, but Thursdays and Fridays, I'm okay with playing at the money cons or two strike prices in the money. To each their own, especially on a Friday and a 0 DTE, I'm definitely playing at the money or one strike price in the money. So this is why it's very important to know how much this name moves on average, right? Very important because this is going to help you select your option contracts. So let's say NVIDIA is at 180. This is one strike price out of the money. So we know if this move goes in our favor, right, we're going to get that. But the reason I wouldn't play three strike prices out of the money on a name like NVIDIA is because what is the likelihood of this moving $5? What is the likelihood of that? So let's go here. Let's go to the charts. Just want to give you guys some visuals. Let's go to the 15-minute. So NVIDIA, we're just going to go with pretty much the low day, which is 178, and the high day, 182. See what I mean there? So what's the likelihood of NVIDIA moving, 5, 10, 20, $30 in a single day? It's not that high. Now let's go to a name like Tesla. This is why it's very important because this helps you pick your contracts. The lower day here on Tesla, 416. The high day, 426. That's a big move. You're not going to get a move like that on Apple. Let's look at Apple, right? You got to know the average. So the lower day here, 276. The high day, 279. See the difference there? So if I go back to my options and I say, okay, well, I know Apple doesn't move that much. We can clearly see the lower day was 276 and the high day is 279. Well, I'm playing 3 strike prices out of the money because what is the likelihood of Apple actually getting to 285, getting to 282? See what I mean there? I really hope that makes sense. So this is why less is more. You utilize that, right? You understand the personality of that stock, and that helps you pick the right option contracts. So I hope this helps. I hope you're able to utilize this and understand how to, as the week goes on, you're becoming more conservative. You're being more on defense. Really hope that makes sense. So just a more little quick recap, just so you can understand everything thoroughly. The main things here that you want to know at all times is one, the average IV. You want to know the average IV. You always want to look at the bid and the ask. I want tight spreads, no more than 15 cents. That's for me. For me personally, I'm always looking at the delta, right? 28, 17, 10, 6. I'm not touching that. For me personally, 40 and higher is good, preferably 45 and higher. See here how the delta is 46 to 59? That's perfect. I want that. The lower the delta, the worse. But keep in mind, that's just my opinion. And then number one, understanding, right? On average what the stock moves on the daily. That's going to help you understand, like, okay, well, Apple's already moved $5, so why would I play one strike price out of the money? Because what is the likelihood of this thing moving another $2, $3, $4? Hope that makes sense. So on a name that, and I'll set this and I'll say it one more time, a name that you can only really play out of the money, and this is what I do myself, is a name like Tesla. Because look at Tesla right now. It's at 426. We play two strike prices out of the money, 430. We're going to get there. We know that without hesitation. We can even get to 432 on a name like Tesla if we're not overextended. So I hope I've simplified this. I hope all this makes sense. Please don't forget to like, subscribe, and leave any questions. I know sometimes learning option contracts can be sometimes of a foreign language or it can be very complex. I tried to simplify this the best way that I could, but you want to know the basics. You want to know the delta. You want to know what the bid and ask is, what a tight spread versus a wide spread is. You want to look at the volume. You always want high volume. Now, if you're trading those main tech names, you never have to worry about the volume. The volume is always going to be there. Liquidity is always going to be there, right? Build a habit of as soon as you open up your charts, You look to your top right and look at the IV. That's going to help. Like these are how you filter out bad trades. You can see a good technical analysis set up on the charts, and then you come to the option contracts and you're like, yeah, this doesn't look good. The IV is very high, the delta is very low, the spreads are very wide. Yeah, it's a good technical analysis setup, but if I take this trade, I'm already starting at a disadvantage. So hope this helps. Hope that makes sense. Appreciate the love, support, and I will see you guys on the next one.